You ever get that sinking feeling? You buy a stock right at the absolute peak just before it tanks. Or maybe you sell at the very bottom and then you just have to watch it rocket up without you. Yeah, it's a feeling we all know. But what if there were visual clues, actual patterns in the charts that could warn us about these big turning points?
All right, so here's what we're going to cover. First, we'll get into what it looks like when a trend is actually reversing. Then we'll dive into the big one, the head and shoulders top, and its opposite, the bottom. After that, we'll look at some simpler versions, the doubles and triples. And to wrap it all up, we'll touch on how you can actually use these patterns.
Okay, first things first, we have to lay the groundwork. What are we really looking for when a big, strong trend starts to run out of steam and, get ready to flip?
This is the question, right, for pretty much anyone in the markets. And look, there's no magic crystal ball here. But what we do have is a way to make a really educated guess. It's all about studying the footprints left behind in the charts, the price, the volume. It's like reading the collective mood of the market, which, funny enough, tends to form these patterns we can learn to recognize.
And this is super important. We're not just talking about a little pause, where the market catches its breath and goes sideways for a bit. No, a major reversal pattern is a huge warning sign. It's telling you that the whole direction, the main trend, might be about to do a complete 180.
This brings us to a really simple but powerful rule of thumb. Just remember this. The bigger the pattern, the bigger the potential move. And when I say bigger, I mean two things: how long it takes to form and how wide the price swings are. Think about it. A pattern that's been building for months with these huge, volatile swings, well, that's got way more energy coiled up in it than something that just pops up over a couple of weeks. The breakout is going to be that much more significant.
All right, so keeping that big idea in mind, let's get to the main event. We're going to look at probably the most famous and maybe most reliable topping pattern out there, the head and shoulders. There's a good reason everyone in charting knows this one.
Okay, so this is the textbook example. It's perfect. The best way to think about it is like a story in three parts. First, you get a strong push-up. That's the left shoulder. Then, the market gives it one last, final, exhaustive effort to a new high. That's the head. But then look at the final rally, the right shoulder. It just doesn't have the same energy. It fails to get back to that high. That right there is the market telling you the buyers are getting tired.
So if we break it down, you can really see the story of a trend dying out. That rally that forms the head, if it happens on lighter volume, that's your first clue. There's less excitement than before. Then the right shoulder failing to make a new high, that's an even bigger red flag. But, and this is key, the pattern isn't really confirmed until the price breaks down below that support level, what we call the neckline. That's the point of no return.
And here we go, a real-world example. This isn't some perfect drawing. This is an actual weekly chart of Nike. You can see it clear as day. The left shoulder, the head, the weaker right shoulder, and then bam! That break of the neckline was the signal. The uptrend was done.
Okay, so now that we know what a top looks like, what about a bottom? Well, you just flip the whole thing upside down. It's called an inverse head and shoulders, and it's a sign that a downtrend might be over.
Seriously? It's a perfect mirror image. Instead of three peaks pushing up, you get three troughs trying to push down. You get a left shoulder low, a deeper low for the head, and then a higher low for the right shoulder. And that neckline? Now it's a resistance level that the price needs to break above. But here's a really critical difference between tops and bottoms. Think about it. For a market to top out, it can just run out of gas. It can just fall of its own weight because the buyers disappear. But to start a new uptrend, that takes energy. It needs fuel. You need a big surge of buyers to push it higher. And that's why for bottoming patterns, a huge spike in volume on that breakout is absolutely essential. It's the confirmation you're looking for.
And here's the inverse pattern in action. You can almost feel the struggle here. The sellers tried to push it down once, twice, 3 times, and they just couldn't break it. That final push above the neckline, that was like the starting pistol for a whole new bull market. All right, we've tackled the most complex pattern. Now let's check out some simpler, but just as powerful variations on that idea. Double and triple tops and bottoms.
You'll hear these called M formations, because, well, that's what they look like. The market rallies up to a price level and gets rejected. It pulls back, tries again, and gets rejected again. Maybe it even tries a third time. Every time it fails to break through that ceiling, it's just screaming that the buyers don't have what it takes to push this thing higher.
And on the flip side, you have the bottoms, which look like a W. It's the exact opposite story. It's like the market draws a line in the sand, a floor. Price hits it once, bounces. It hits it again and bounces again. When it refuses to go lower, that's a huge sign that the sellers are finally tapped out and the buyers are starting to step in and take over.
Okay, so it's one thing to spot these patterns on a chart, but what do you do with that information? Let's talk a little bit about how this actually gets applied.
So once a pattern is confirmed, with the break of that neckline, you can actually get a rough idea of how far the price might go. What traders do is measure the height of the pattern itself, say from the top of the head down to the neckline. Then they take that distance and project it from the point where it broke out. This gives them a minimum price target. Now, it's not a sure thing, not at all, but it's a logical target based on how big the pattern was.
But, and this is a massive but, you have to remember, these patterns fail. They absolutely do. Sometimes you'll see a picture-perfect breakout of the neckline, and then, whoop, it snaps right back in the other direction and continues the old trend. It's called a whipsaw, and it's one of the most frustrating things that can happen.
And that brings us to maybe the single most important lesson of all. And I'm quoting here, none of these chart patterns are infallible. They just aren't. They work a lot of the time, but not always. This isn't about predicting the future with 100% certainty. It's all a game of probabilities. Using these patterns is about stacking the odds in your favor. That's it. It's never, ever a guarantee.
Okay, so let's just quickly wrap up the key takeaways here. First, these reversal patterns, they're your early warning system for a big trend change. Second, the head and shoulders is the classic one you gotta know. Third, always watch the volume, especially when you think you've spotted a bottom. And finally, and I can't say this enough, no pattern is perfect. They're tools for weighing the odds, not crystal balls.
So I'll leave you with this final thought. The next time you pull up a price chart, try not to just see a bunch of squiggly lines. Try to see the story. See the fight that's happening between the buyers and the sellers. Because now that you can recognize some of these shapes, now that you're starting to learn the language, what stories are you going to start seeing in the charts all around you?